And thanks, everyone. I appreciate the opportunity to speak to you on an economic history topic that I think has some relevance for the modern recent crisis and even earlier crises. This is joint work with Margaret Jacobson, a former student of mine at Oberlin College, and presently a research assistant at the Federal Reserve Bank of Cleveland, soon to be a graduate student at Indiana University. So further, classic disclaimer, these views are the views of Maggie and myself and not those of the Federal Reserve Bank of Cleveland or the Federal Reserve System generally. So 1914, the provision of liquidity as a crisis was impending in the United States had two sources, one public and one private. And just to give you a sense of the current mood, we have a quote from Alexander Dana Noyes. This series of preliminary episodes may perhaps be best characterized as the fight of the civilized world to avert the greatest panic in economic history. So there's a little bit of perhaps exaggeration, but that was perceived at the time. The general insolvency, which had so widely been predicted in advance, was escaped, as we have seen, partly through the support on a quite unheard of scale by private by public credit. Recourse to these expedients had also helped to avert that complete collapse of international trade, which the British Foreign Office had foretold on the eve of the war. By the way, this is a fabulous book, and it's a great read for anyone who's got a hankering for the 100-year centennial for World War I. So our paper explains, or at least investigates, why these crisis prevention mechanisms that were used in 1914 were so successful, more effective in 1914 than in prior crises. These actions supported continued growth in the monetary aggregates, which didn't occur in the previous national banking era crises. Now, I will say that any analysis of 1914 usually gives effectively all the credit to the issuance of emergency currency. This was a new mechanism that was part of the 1908 Aldrich-Vreeland Act that came in response to the panic of 1907. But what we show, we investigate previously overlooked data about the palliative role of clearinghouse loan certificates, the private source of liquidity in terms of alleviating this crisis. I think sort of the bottom line, the key element, that there were better outcomes for non-national banks as a result of the issuance of clearinghouse loan certificates. And the reason why is that in 1907, those institutions that were not members of the clearinghouse, and trust companies were one of them, they suffered tremendous contraction. Now, how do these findings refer to the recent crisis or any crisis that might be forthcoming? So in the recent crisis in the United States, as early as 2007, it was recognized that the financial infrastructure was clogged. There were intermediaries that were lacking liquidity, lacking access to liquidity, and liquidity didn't flow smoothly across intermediaries, whether across institutions or across institutional types. The Fed determined that the solutions would be to add liquidity directly to these markets, liquidity aimed specifically at institutional types, with specific liquidity programs. And some of those programs were quite controversial. Liquidity was offered to the primary dealers, for example, the primary dealers credit facility. Liquidity was offered directly to the commercial paper market. And that's not even in describing the term auction credit facility. Am I missing something? The term auction credit facility was merely a method to get liquidity to the banks without they were trying to get liquidity to the banks without revealing their identity. The discount window was perceived as being problematic. It's echo?
Yeah, there's
Okay.
some echo.
Okay. So I'll just cover one more thing. So the recent crisis in the U.S. and the 1914 experience have this similar solution: add liquidity directly and have different liquidity programs. Clearinghouse loan certificates were for essentially non-Fed member institutions, as well as those institutions that might be Fed members but need additional liquidity. Emergency currency was supposed to be the complete solution, but that liquidity was only offered to national banks or banks that were committed to becoming Federal Reserve System members. And not many state banks and in New York City, no trusts became members. So this is kind of the counterfactual claim, and it's a pretty strong claim. But we feel like emergency currency alone would not have been sufficient to stave off the crisis. And I admit that the evidence that exists to support this is insufficient, but the evidence is, well, let's just look back at 1907. Trust companies had no access to the clearinghouse or any liquidity form, and we can see what happened there. So that's sort of like the overview before I get into the institutional details. And I'm ready to take a break here for a moment in case there are any questions. Okay, then I will go ahead and push on. Here I'm going to be going through a number of I don't see anything.
Okay.
So I'm going to go.
Yeah. Yeah. So, but there is some echo. I'd like to eliminate it here. Un poco de echo.
Should I step back maybe?
Just a second. So I don't know if maybe no, está muy alta la voz. Podríamos ver.
So I should pause?
Yeah, just 1 second. En Venezuela, ¿ustedes escuchan eco?
Sonido. Give it a try.
Yeah. Oh, Calixto, ¿escuchas eco?
No echo.
Ok. Bueno, muchas gracias.
Thank you. Okay, so let me go through some institutional detail. What I hope to show is that financial and economic history is actually relevant for policies designed to address today's crises. Counterfactuals are essentially all we can do in economic history. Here, without a secondary source of liquidity, the crisis of 1914 might have been much worse maybe worse, maybe not much worse. But the two liquidity sources, increased cash balances, or the equivalents at New York City banks, by about 50%. That's huge. And in fact, to compare throughout Fed history, there's really no comparable period aside from what happened in 2008. The isolation of the trust companies in 1907, during that panic, trust companies did not get any aid from the clearinghouse, which was the only source of liquidity. There was no Aldrich-Vreeland emergency currency. In 1914, these clearinghouse loan certificates were issued to state bank and trust companies that were members, and the trust companies learned their lesson from 1907, and those that were involved in intermediation in a more active form joined the clearinghouse. No panic ensued, and effectively, this is our case. So let me push on to the background. So if you look in sort of economic history surveys, 1914 sometimes is referred to as a crisis, but it's an event that is not major, but it could have been major. This is actually, the time was July, August of 1914, and it was really before the Federal Reserve System became operational. That didn't take hold until about mid-November. So here we are, July 31st, when things start to happen. Okay, now you're getting the feedback. Maybe I back off. July or August is when things started to happen. There was a liquidity crisis, but there was no banking panic. So the interventions were taken by the Treasury and by the large bankers in conjunction with the stock market. The Treasury under William McAdoo anticipated that there was going to be problems, and in fact, just to put it on the side, he organized a congressional amendment to the Aldrich-Vreeland Act that allowed emergency currency to have an additional year. It was supposed to essentially terminate soon after the passage of the Federal Reserve Act. But he kind of knew what was going on. He had it passed. That kind of expanded the term for this policy. So the public liquidity provision was through Aldrich-Vreeland emergency currency. The market participants, the private liquidity provision was through clearinghouse loan certificates, which had been used in a number of previous crises. So in July of 1914, there were trepidations in Europe. There was clearly an impending war. So from July 27th to July 30th, European stock markets bourses are closing. Now, the arguments for it would be, to prevent dislocations, prevent gold outflows. In July 31st, the New York Stock Exchange was closed by the Secretary of the Treasury after consulting with the New York Stock Exchange. Now, this sounds like sort of a rational response to the rest of the financial world. Why stay open while the other institutions are closed? Basically, be drained of liquidity. So the financial conditions were actually fairly benign in New York in comparison to Europe, but the stock market closure had important effects on the liquidity in the New York City financial market. The fear pardon me, the stock market closure prevented liquidation of the U.S. gold supply. William Silver, in 2007, he wrote a book about this entire event. And basically, he argued that McAdoo wanted to preserve the gold standard in the United States and then advance New York as a financial center. Foreign investors were liquidating U.S. stocks into gold and shipping gold to London in the week prior to the closure. And we know the gold standard could have implied a contraction in the money supply as a contraction of the base money as gold moved out. The fear of stock liquidations, policymakers feared fire sales of assets. Silver argues that those fears were unwarranted. It's not all that relevant for our argument, but I just thought I'd mention that in passing. So here's where the problem arose from the closure of the stock market. In the United States at that time, the structure of the national banking system, there was no explicit lender of last resort. The Fed legislation was passed, but it was not operational. So there was really no mechanism to adjust the base money supply in a rapid fashion. The financial system, if you look in terms of the history, the financial system was prone to runs by banks and depositors on the financial system. Some crises were worse than others. The New York National Banks in this system were the reserve depositories of the rest of the United States. It's referred to as the pyramid structure of reserves, and I'll go through a bit of that in a minute. New York City national banks typically held their excess reserves in the call loan market at the New York Stock Exchange. So their secondary source of reserves were demand loans, call loans, that were considered liquid, right? Because they're stock market collateral. If the borrower doesn't pay, we can sell the stock market collateral. So the closure of the New York Stock Exchange made these call loans illiquid. And so there was a clear risk of a cash scramble. Now, how was this call loan market really operating? It was effectively the equivalent of the federal funds market in terms of shifting liquidity among banks. It's just that a bank would have a call loan. If they called it in, that the borrower had to repay it. Normally, the borrower would simply find another bank to finance their loan. So in a sense, it was sort of transferring idiosyncratic liquidity demands across banks. Not a big deal. But I think you can already sense that during a systemic issue, when all banks have to liquidate, the stock market would be a problematic place to have loans. That said, when you shut down the stock market, that mechanism for smoothing out idiosyncratic liquidity demands is shut down. So here's the reserves in the national banking. The U.S. banking system, if I went into it, you'd wonder. I mean, there was a joke that a banking economist used to tell, that if people from outer space came down to the U.S. banking system, it'd be the most confusing thing that they face. But let me just say that in the national banking year, these are the nationally chartered banks, country banks, the ones on the left side here. These banks have to have 6% of their deposits in the vault as cash, and they can have 9% in reserve city banks. Now, the reserve city banks, are the larger banks in bigger cities. Large New York national banks were the key holders of the reserves of reserve city banks. Things going okay?
Yeah.
Okay.
You can use your arrow if you
Oh,
want.
I can do that.
Yeah.
Okay, thank you. So, so let's talk about these guys, the reserve city banks. So they have to hold 12.5% of their deposits in terms of their deposits in cash, and then they can have 12.5% of their reserves held in. I just click.
Yeah.
In pardon me, in national banks, clearinghouse, these guys. So just to throw in some of the detail, I mean, the large New York City national banks would pay interest on their reserves, which was a really controversial thing. But that would attract most of the deposits from the reserve city banks into the New York national banks. That said, okay, so what would the large national banks do with these reserves? Most of the time, these reserves were just sitting. So the New York national banks would invest them in call loans in the stock market. And okay, so what I do, pardon me, these. All right. Yeah. So okay. So you can see that it's kind of complicated. But what happens during a panic? Something happens where the rest of the country worries about the deposits in the large New York national banks, and these 12.5% of Reserve City Bank reserves held in New York are drained out. Didn't happen here because of the following reason. Well, we'll go into that in a minute. But let me just tell you where. So here's the interbank deposits. Where are they being held? Well, as you can see, nearly 400 million are in New York City. 150 million in Chicago. That's also a central reserve city bank. St. Louis was a central reserve city bank, but you can also see they weren't as important as Chicago or New York. Okay, so here's how reserves in 1914 operated. You have the small New York national banks, large New York national banks, and then the clearinghouse national banks. These are all banks that are interacting together. And the large New York national banks are primarily funding call loans in the stock market. So the closure of the 1914 stock market prevents these New York national banks from rearranging, adjusting their short-term balances using call loans. There's no federal funds market to adjust these reserves, and commercial paper was really quite a small market at this time. So how this happened in the past was that there'd be a crisis, and the New York national banks would be struck by demands for cash from the interior banks. That would then lead them to suspend cash payment, and then a contraction in the money supply. All right, so you can see here, these are actually huge outflows. And if I had a time series, you'd see that these two events are the most obvious. So this is 1893. There were essentially two periods of drains from New York. One in early June, and then again in August. And then here, this is 1907. Normally, this line here would be more about, pardon me. Yeah, this would probably be somewhere here. This line would just kind of continue until in December, it hits balance. But you can see this drain of cash from New York City to the interior during the Panic of 1907. Well, here's what happened in 1914. So there's this very, very slight, sharp drain. I mean, it's substantial right in the beginning of August. But as you see, there's a quick recovery. And our argument is that the liquidity provision mechanisms, and it could be largely Aldrich-Vreeland, but also clearinghouse loan certificates, allowed the New York national banks to satisfy interior demands for this one little period, and yet, essentially offset any crisis outflows. And here's two lines to demonstrate the difference between 1907 and 1914. So in 1907, once the panic started, there was a contraction in the money supply. And there, in 1914, and remember, there was a suspension of convertibility, so you're not going to have participants re-intermediating right away. Here, you can see in 1914, sure, there was a little period in September, October, when there was some concern, but still, on net, there's an increase in the money supply. So it actually never contracted. Credit was supported. Okay. The existing literature suggests success in 1914 was essentially associated with the actions of policymakers, Silver, that William McAdoo had great foresight. He initiated these constitutional extensions of Aldrich-Vreeland so that the liquidity could be preserved and the liquidity mechanism would be around. Friedman and Schwartz, Wicker in 2005, and Silver also argue that the invention of emergency currency was the key. And in fact, Wicker basically said soon after the Aldrich-Vreeland emergency currency were issued, clearinghouse loan certificates disappeared. So in a sense, these modern researchers suggest that clearinghouse loan certificates were relics. They were dominated by Aldrich-Vreeland emergency currency, and that actually is conflicted by some contemporary observers of 1914. The one and most important one for us was Noyes, who essentially said they were both important. And there was an article in the Commercial and Financial Chronicle, which was at the time sort of like the Economist of New York City financial markets. It was a weekly issue, and they argued that it was crucial to have clearinghouse loan certificates. So we wanted to enter into this debate and see if we can show something. So what does this page show? What does this slide show? It's essentially currency held by the public. You can see that there was cash hoarding in 1907, and there was also cash hoarding in 1914. The key difference is that in 1914, the cash hoarding was effectively satisfied by emergency currency issue. Now, this was exactly what the clearinghouse loan certificates could not supply. Clearinghouse loan certificates in New York City were used as a form of payment in the wholesale clearinghouse, and they could not circulate outside the clearinghouse. Emergency currency issues were mainly to pay bank depositors and individual depositors cash in exchange for their deposits. And essentially, emergency currency did save that day. So what do we have? We have data on New York City clearinghouse member banks. We have nearly half of the banking assets in 1914 were in New York City. And New York City banks were those that were most acutely affected by the closure of the stock market. we actually have daily data. I have daily data on emergency currency issues and clearinghouse loan certificate requests and those that were received by bank. So in other words, we have requests and then we have allocation. I have weekly balance sheet items of a subset of items on the balance sheet that are available weekly, up to, but then following the onset of the distress, we only have aggregate numbers. And then we have aggregate weekly numbers for the clearinghouse during the crisis. So here's something that should be right up front. Clearinghouse loan certificates and emergency currency were pretty different, although they have very similar structures. So I'll go through clearinghouse loan certificates because I think they're probably the more foreign. So clearinghouse loan certificates offered 6% interest to the bearer of the certificate. So if I borrow from the clearinghouse and then I issue the certificate, the clearinghouse doesn't get the interest. The holder gets the interest. Second, I'm the borrower. The clearinghouse is the lender, but actually the lender is whoever holds the clearinghouse loan certificate. And if there were losses on a clearinghouse loan certificate, there weren't any, but if there were, the clearinghouse generally would share that loss. So in a sense, the clearinghouse guaranteed the clearinghouse loan certificate. That is, all members of the clearinghouse. It could not circulate to the public as currency in New York City. It elsewhere. State banks, trusts, and national banks that were members of the clearinghouse could borrow them, and these were issued throughout the national banking era. Aldrich-Vreeland emergency currency. There's 3% interest for 3 months. And then each month, after 3 months, the interest rate would increase by 0.5%. So it'd be 3.5% in the 4th month, 4% in the 5th month. It just would accumulate 4.5%. It was issued by the U.S. Treasury. It could be paid out to depositors. It was only national banks or banks that were committed to joining the Federal Reserve System, which meant pretty much only national banks. It was only issued in 1914, and the limitation here, it was an explicit limitation that you could borrow up to 125% of capital surplus. This was never a binding constraint, but it came close in 1 or 2 instances. Okay, I really like these pictures. This national banknote, this emergency currency. Warren Weber went ballistic when he said, "What do these look like?" And I didn't have pictures. And these are pretty close, don't you think? I mean, you can kind of tell they're different. There's something that suggests that they're different, but you can't really tell. So, okay, on the back is very different. See this 1902, 1908? This is one of the key differences. So this would determine, if you flipped over your national bank note, you saw these numbers, you knew you had emergency currency. Well, what's the big difference between emergency currency and national banknotes? So here it is. This is a national bank note that says secured by United States bonds deposited with the U.S. Treasury, right? So it's U.S. bonds. Now, let's go to the next one. This is emergency currency. Very subtle, but secured by United States bonds or other securities. Boy, that does sound somewhat provocative, doesn't it? The other securities were actually pretty restrictive. But we'll get to that in a minute. I am unable at this point, Alberto, to see a few things because the computer wants to do a backup, and I don't want it to. So here's another. I mean, it seems like an obvious thing. I learned this. I don't know what to do with that. So the national bank notes, including emergency currency, you can see the national bank note circulation numbers, the red bars. Thank you. The red bars are the denominations of emergency currency. And you can see there was nothing over 100. So these are definitely meant to be hand-to-hand currency. If you look at clearinghouse loan certificates, the denominations and the amounts issued, the percent value of liquidity issued, well, clearly $100,000, this is a clearing balance. So these were meant for wholesale payment. Great question by George Selgin. He thought that these data existed. We found it, and it's made a really cool graph. So this should let us know that clearinghouse loan certificates were used for wholesale payments. National bank notes were used for giving depositors their cash. Okay, total borrowing in New York City by liquidity provision, you can see that more than 50% was in the form of emergency currency. I'm not denying that that was critically important, but this 269,000 number is quite huge in an equivalent amount relative to, say, 1907. This is about 50%, maybe even 60% more than. I mean, in 1907, it was essentially 88 million at the most in terms of clearinghouse loans. So this is more than double. Now, further, total borrowing by intermediary type. Here it is clear that national banks are borrowing the most. And one reason one could think is, first, they had access to Aldrich-Vreeland emergency currency. But secondly, they were clearly the more important intermediary in the correspondent banking system in the United States. So the 12% by trust companies, this may be small in a sense, but it's so important that this intermediary type was getting access to liquidity. I mean, this is exactly what didn't happen during the Panic of 1907. And then total banking assets in New York City by bank type. Now, in 1907, this here, 38% by trust companies, would have been like 48%. It was 45%, and national banks would be 48%. They were very close to national banks. But after the panic of 1907, trust companies struggled a little bit, never really regained their footing. But you can see they're still very important. But again, they're not necessarily important as part of the intermediation system, part of the payment system. So here's the comparison of liquidity provision mechanisms. And up front, I want to explain that I actually have data on the issues of clearinghouse loan certificates and the cancellations of clearinghouse loan certificates. So when we get down to here, I know that is data, that by November 27th, there were no clearinghouse loan certificates remaining outstanding in New York City. Cannot say the same thing about emergency currency. As you can tell about here, what Maggie and I had to do was use aggregate estimates from the Treasury Department regarding how many Aldrich-Vreeland emergency currency provisions were outstanding in New York City. So this is an interpolation. So I don't really know what these are. At the same time, you can see that emergency currency issues increased. They increased a lot during September. And then they kind of plateau in October. One can see something, it'll be more obvious in the next slide. But there was sort of an initial request for these intermediary liquidity provisions. But then there was also a secondary request. And these are things that Maggie and I are interested in looking into going forward. So this is clearinghouse loan certificates in New York City by type. So as you see, national banks have a pretty different structure of their demand. And it seems that in early September, national banks have a second surge of requests for clearinghouse loan certificates, which then dissipates quite quickly through October and then even faster through November. On the other hand, we have this very rapid increase in August for state bank and trust company requests that plateaus during September and starts to slowly decline in October much more rapidly here in November. Again, something to look into, not necessarily crucial for the point we're going to make today. So, we have a very simple hypothesis. We just thought that the borrowers of temporary liquidity in either form should maintain their deposit levels in the midst of distress, and that would be a superior strategy than not borrowing. So we agree here that national banks borrowed for different reasons. Now we can see that national banks, their emergency currency could satisfy cash withdrawal demands from depositors or cash demands from interior banks, whereas clearinghouse loan certificates offset clearing balances at the clearinghouse, some adverse clearing balances, whether maybe a local bank is there's an adjustment across banks. So it's kind of a wholesale versus a retail issue. Now, on the other hand, state banks and trust companies, they had no alternative mechanism at hand for increasing their liquidity. They used clearinghouse loan certificates as any means to address withdrawal demands from any source, whether it's a clearing balance or whether it's depositors withdrawing cash. The mechanism, it's a very subtle one. The clearinghouse was sort of like, they had the same structure as a casino. They didn't like people passing cash, and it's especially gold, to balance their final payments. So a bank would bring legal tender, which were national bank notes issued through the Civil War in the United States, in addition to gold. They deposit it. And essentially, they got these certificates, or I think of them as casino chips. And then the banks would trade those. So you have these certificates that relate to gold, and then you have clearinghouse loan certificates that relate to other assets. And they traded at par, although the holder of a clearinghouse loan certificate got this interest payment. So when a trust company that took out a lot of clearinghouse loan certificates put them into the clearinghouse, they could pretty much withdraw their legal tender from the clearinghouse, which is essentially what they did. They substituted it out. It's not as good as additional cash, but it's better than nothing. It took us forever to prove that. But there were a number of doubters, like, no, there's no cash. Well, there was. That's the way they did it. And not that I gamble, but the casino analogy seems to work for people. And I'd be glad to go into detail on some of these mechanisms if you'd like. Okay. So the base money supply constraint. If there were no borrowing, this is where we figure the base money would be. So you have this amount of base money. You can give some to cash. You can give it all to as cash for depositors, and you can go out of business. I mean, you could retain some for clearing balances. At the clearinghouse, if you borrow only clearinghouse loan certificates, you can still only do this much for cash for depositors, but in a sense, you pushed out this boundary by the amount of clearinghouse loan certificates that you have, because you have credit. But then further, if you borrow both clearinghouse loan certificates and Aldrich-Vreeland emergency currency, you push it out to here. And the reason is that clearinghouse loan certificates were accepted at the clearinghouse, but Aldrich-Vreeland emergency currency was not accepted at the clearinghouse for final payment. And in fact, they never accepted national banknotes for final payment. So why would they take emergency currency, which was effectively national banknotes with weaker collateral? So that's kind of the gist of the story. Now, empirically, this is incredibly basic. We did a simple comparison of the institutions grouped by their borrowing and looked at their aggregate deposit level before the distress and after the distress. Now, we have four groups. We have the groups that borrowed neither form of temporary liquidity. We have the borrowers that only borrowed clearinghouse loan certificates, and those are the state trust institutions. And then we have those that only borrowed emergency currency, and those are the national banks that chose only to borrow emergency currency. And then we have this other group of national banks that borrowed both emergency currency and clearinghouse loan certificates. So we have these four groups. So the simple hypothesis is that borrowers of temporary liquidity in either form will maintain deposit levels in the midst of distress. And then we just look at the 1914 experience to assess that. We can compare the pre and post distress deposit levels to sort of analogous levels from previous national banking era crises too, but I'll just show you briefly what we've got here. Okay, so here we've got total net deposits for national banks, and the brown line is loans. So you can see that loans definitely declined during this crisis, but deposits actually increase, and the total borrowing that banks do kind of helps support that. Okay. Banking activity during 1914 was kind of flat, but during the three major crises in the national banking era, banking activity really took a hit. So let's just get to the gist. Is borrowing status associated with deposit level changes? Here, we looked at net deposit levels from August to December using these weekly reports that were made in the Commercial and Financial Chronicle. The difficulty with using more detailed information from the comptroller of the currency is that we didn't find an observation for December. There should be one, but we don't have it yet. So we're using these weekly reports, which reduces our sample from 111 to about 78. But let me explain that it weakens the non-national bank sample somewhat more than the national bank sample. Although I think you'll see these are pretty substantially, these are pretty large numbers. So total net deposits by borrowing status. You can see here those banks that borrowed only emergency currency. Well, their deposits increased by 9.3%. Institutions that borrowed only clearinghouse loan certificates, they increased by 15.3%. Banks that borrowed none, their deposits actually increased by 5%. And here's the conundrum. The banks that borrowed both, which is clearly a subset of national banks, their deposits contracted by 3%. So, just at this level, we feel, all right, we have some evidence in support of our argument. So before I go through the discussion, are there any questions yet? I know that this is foreign, it's arcane institutional material that I've been studying a long time. And so I'm very comfortable with it. I've tried to boil it down to the basics of what you need to know, but I'm sure there'll be questions. If there are no questions, I'll go on. So during the national banking era, clearinghouse loan certificates were the only choice, the only mechanism for issuing temporary liquidity. And they were unsuccessful in generating an increase in the money supply. I think one of the more obvious differences is in the most serious financial crises during the national banking era, 1873, 1893, 1907. Suspension of convertibility was also imposed, creating perhaps a large complication. That said, in 1914, the fact that these intermediation liquidity provision mechanisms were issued simultaneously, both clearinghouse loan certificates and Aldrich-Vreeland emergency currency, largely prevented the need from a suspension of convertibility. So the different association in 1914 is that clearinghouse loan certificates were taken out by many intermediaries, even those intermediaries that were borrowing emergency currency. Clearinghouse loan certificates were associated with deposit growth. Trust companies and state banks that had no alternative utilized this liquidity provision mechanism substantially. For national banks, clearinghouse loan certificates were a secondary source of liquidity. We know that they were less stringent collateral requirements. We know that they have a different use And we also know that they were more expensive, twice the interest payment. So understanding that is certainly something for further research. So how this is relevant for policies implemented during 2007, 2009, well, during that period, normal financial market lending just broke down. And the provision of liquidity directly to markets in need of liquidity is analogous to offering clearinghouse loan certificates to those institutions that could not get emergency currency. And maybe, we don't know yet, maybe those institutions, those national banks that were running up against maybe collateral constraints or perhaps functional constraints, that they needed wholesale liquidity, not retail liquidity. These things, I think, could be useful for us to identify. So, to come up with conclusions, I think we have some data that can shed light on a potential crisis that was avoided by innovative liquidity provision mechanisms. Intermediaries in 1914 were able to maintain deposit levels and somewhat retain their credit levels despite the closure of the New York Stock Exchange. And it's one of the few national banking era panics. It stands out because deposits, loans, and aggregate money supply at some point all increased. The temporary liquidity provision mechanisms, the two of them, were issued to a wide range of financial institutions, and they didn't really require the national banks, say, to lend to the trust company, that the trust companies could get credit from the clearinghouse because they were members. The borrowers of liquidity maintained their deposit levels to a greater extent than non-borrowers. And the counterfactual thought experiment that we suggest, we haven't really made it compelling yet. Would deposits have grown at non-national banks, that if the clearinghouse loan certificates were not issued, would the non-member banks, pardon me, the non-Fed member banks have been able to extract liquidity from the remaining banks if there were no clearinghouse loan certificates? Or, if would the deposits have grown at non-borrowing banks if there was no borrowing by any bank? That latter, I think, this counterfactual in print, I think, I have a pretty strong opinion on that. It's not an experiment I want to. It's not an experiment I want to actually implement in a real economy. So, so further thoughts on 1914 and its relevance for today. I think the financial market transactions were supported. The large participants, and I mean the large trust companies, after the 1907 panic, joined the clearinghouse because they knew they needed some kind of connection to a liquidity source. The most provocative, and I think the most important finding we come up with, is that borrowers of clearinghouse loan certificates among trust companies led to a large increase in deposits. We have this other one, this provocative finding that we really can't decipher just yet, is that national banks that borrowed both clearinghouse loan certificates and emergency currency experienced a net deposit contraction. Here, it's provocative because there are a number of ways to think about this. Were these institutions that were desperate for credit? Were they being drained of liquidity from correspondents? data likely exists, but they're not readily accessible. They're the kinds that I have to go to the National Archives in Maryland and actually, blow off dust off of old books and type in the numbers. Or if I'm more high tech, I'll take photos and then get a research assistant to type them in. But it's potential, but we don't have that data yet. And then finally, one could take this same angle and examine the recent crisis for similar issues. And my provocative question is: we're in 2008, 2007, 2008. Were there some borrowers more desperate than others? And largely, we know there were. The question is whether these data might show that. So that's effectively all I have prepared on my paper, but I'm glad to take any questions or whether they're. So let me read the question. The key stabilizing element was the provision of the needed liquidity, but what was the exit strategy, and were there any noticeable effects afterwards? Excellent question. Let me tell you up front that I failed to, when I noticed, let me go back about 5 slides to address this question. All right, more than 5. Okay. Here, the exit strategy of this liquidity provision was the cost. Clearinghouse loan certificates were 6% and on an annual basis. They were costly. And you did have to offer collateral, which was then given a haircut off its market value of 25%. So you got 75% of the value of your collateral to get some clearinghouse loan certificate. So as you can see, these were the ones that kind of terminate earliest. Emergency currency, they have a 3% interest rate for 3 months, and that's at an annual rate. With they didn't put as high a haircut on the assets for every type of asset offered. So municipal bonds would get 90% or 10% haircut, but still 3%, then 3.5%, then 4%, then 4.5%. So 6 months. As you can see, nothing lasted longer. So we have very, very few clearinghouse loan certificates outstanding as we get up to the 6%. So it was, I think it was the cost that made it so that these institutions were ready to terminate their borrowing. Now, the other aspect is that this is sort of like the part of the grander scheme that I don't avoid. It's just that it's not easy to characterize. You remember this period here in September, October. It was at this point when there was greatest fear of trade breakdown in the United States. And at that point, the banks felt, oh, we need to take out more liquidity. When that really changed about November 1st, when it was obvious that the war was going to have some the war in Europe was going to have some positive impact on the United States trade position, that there was going to be excess demand for U.S. products. So they could foresee gold inflows from net export surpluses. So there's an element here that arises from sort of the positive inflows, were there any noticeable effects afterwards because of these inflows? Not obviously. But thanks for that question.
If there is
Any other?
any other question, perhaps you can raise your hand and we can open the mic, or you can write down here in the chat.
So I will make a comment about sort of industrial organization. The clearinghouse monitored its members. So they kind of knew who was struggling and who was flush. So they made these loans, recognizing that they're funding competitors, but they also saw the system aspect of providing liquidity. They didn't want to cause a crisis. So just to end the suspense, there are two people typing questions. As soon as they come through, I'll address them. So there's another comment that Wicker makes in his 2005 book, where he says, had this crisis occurred before the passage of the Fed, it is possible that the Fed legislation may never have passed in the United States. That the idea that crisis alleviation was met by this mechanism. Some of the more conservative American economists have taken up on that idea. The problem with Aldrich-Vreeland emergency currency is the same problem that arises with the Fed, and that is incomplete membership. Okay. So the financial infrastructure of 2007, was this infrastructure permanently changed? Well, I think we're experiencing an evolution of the financial infrastructure right now. In terms of, let's think about it this way. The question is financial infrastructure, a change in financial infrastructure. Do I think the 2007 infrastructure was permanently changed? I think Dodd-Frank has changed the way the Fed, and actually the experience of the crisis, changed the way the Fed looks at financial infrastructure. And I think basically virtually everything in a macro-prudential standpoint, anything that can cause a crisis looks like it could be perceived as in the purview of the Fed. So I was at the Fed until just after the Bear Stearns merge with JP Morgan Chase, and I can suspect that there's an unwillingness to allow the amount of information that should have been available to the Fed, but wasn't, because was over-the-counter derivatives situation. That the Fed's going to demand that kind of information. I think the fact that you're forcing more derivatives onto exchanges, that many more of these off-balance sheet item, kind of over-the-counter off-balance sheet items are going to be accounted for one way or the other, because the Fed has to be aware of these things, since it is actually being held responsible from the Dodd-Frank. So certainly, and I think for sure it's a good thing that the infrastructure's changing. One of the reasons I study financial crises in history is that they seem simpler. But when you get through the simple aspects, the same issues arise. What strikes me about the change, and I don't know when the change occurred, the change in banking, when it became kind of banks don't seem to share the same kind of systemic view that they had at the turn of the century, and maybe even as late as the Great Depression. I think your point is taken, and I think what really I would like to do, I mean, this is where, wishful thinking. I would like to see banks have more self-interest in having that systemic view. I think we know enough, very simply, not it doesn't have to be rocket science, to have banks have more skin in the game, so that they are concerned and they are more aware about counterparties. Now here I go a little off, because I mean, I do think that during the national banking era, there was counterparty exposure. It was recognized and it was monitored. And I think that there were shortcomings in counterparty monitoring. Sorry, but the kind of when things got out of hand in 2008. I mean, in retrospect, I'm sure even participants were thinking to themselves, "This is crazy. This is how did we get ourselves in this?" I hope that at least addresses it somewhat. Tough question, one I ought to think about. In the past few years, some of the liquidity provided went to other countries. I understand that times were different and there were more rigidities, but did you observe any sort of capital outflows? Not in this panic, not in 1914. 1907 is different. But when you say, let me force an analogy, this is actually something that's slightly related. It is apparent that the term auction credit facility, all of those liquidity facilities by the Fed, were aimed at supporting many foreign banks that were heavily exposed to dollar liabilities. That was, we knew it when we were there in 2008. We knew it was controversial. We knew it was essential. So what I think the Fed essentially did was avoid the complication that needs to be addressed as well in other situations, which is cross-border bank failures. And I think someone named Richard Herring at the Wharton School at the University of Pennsylvania has been a leading advocate, as well as my former research director, Robert Eisenbeis. basically the Fed helped avoid that circumstance. But I mean, that kind of situation is going to be politically untenable. I mean, I think about it right now, that if something else happened, the politics being what it is in the United States, I'm not sure that as many of the things that were passed, like TARP, would pass right now, and I get concerned about the politics. The capital outflows occurred in previous crises, largely because the losers, like in 1873, the British were funding mainly funding the expansion of railroads in the United States, and that's where some of the interesting issues come up. But I think what you're raising about lending to foreigners tells me that I think the low-hanging fruit from a regulatory standpoint is to address these very complicated, very difficult political issues about how to resolve cross-border bank failures. Because eventually it's going to happen. Again, I don't feel like I've addressed that directly except by saying, no, I didn't observe it in this. But the one element that I haven't thought about, which you're describing, might be relevant in that I know that the U.S. was lending to French and the British during World War I. I don't know when that started, but that might be something for me to look into. Thanks. Well, no one else is typing, so I guess that means that we're pretty much done. Any other questions?
Well, if there there is another question. Okay, this is thank you note from the Central
Okay, thank
Bank
you.
of Venezuela. So you can either raise your questions, Dr. Ellis Tallman, for his contact details and the paper on the seminar's webpage. So if you have further questions, you can contact him, and I'm sure he will be glad to reply to your questions. Thank you very much, Dr. Tallman. And thank you very much to all the participants to this session. Please look at the schedule as we are